Hello and welcome to BQ Prime. September's inflation print is expected to come in within the tolerance band. Economic activity remains steady. However, headwinds have intensified from higher prices of oil as well as erratic monsoons. Now, in all, the MPC will have little reason to change the current policy settings when it meets on the October 6th. Today we have with us A. Prasanna, Chief Economist at ICICI Securities Primary Dealership, to share his expectations from the upcoming policy. Sir, thank you so much for taking time out for us today.
Yeah, hello.
So, to begin with, I'd simply like to ask you, what are your expectations from the forthcoming policy?
Yeah, I think in your introduction you said there won't be any change. So I think you have answered the question. So I think that is the market expectation. That is our expectation also. We don't expect any change in rates. We don't expect any change in stance. Economic forecasts, probably some tweaks to, say, CPI inflation data, CPI inflation estimates, GDP estimate. We expect RBI to retain its forecast. So by and large, we don't think there's going to be any big change in this policy. The only thing to watch out for is in terms of commentary. And I think, like you mentioned, I think there are some worrying signs like crude prices. Of course, today it's overnight it's come down, but generally compared to last policy, it's moved up. And food inflation, again, if you look at it, I think although the vegetable prices have come down, I think if you look at the rest of the food basket, again, there are pockets of worry like cereals and pulses. So these are all things which are worrying signs. So probably what we think will happen is the RBI and the MPC, probably the language, it will be a bit more hawkish. Probably they will kind of highlight these risks to inflation and mention that they are being vigilant about inflation risk. But otherwise, we don't expect any action or any change in the stance.
Right. So some of the factors that you touched upon, I'd like to delve a little bit more into those. Starting, of course, with oil prices. I think that's one big change we'll see from the last policy to this policy. And the RBI has factored in oil at about $85 per barrel for the year on an average. Currently, we're far ahead of that. What's the expectation? I know the environment is a little volatile to be able to predict what oil prices will be for the remaining fiscal year, but there are clear headwinds to the Indian economy if these high prices persist for the next few months. Could you elaborate a little bit on that?
Yeah, so I think if you look before the recent rise in oil prices, I think if you look at the average oil price for the financial year, it's been lower. It was lower than the $85 which the RBI used in its assessment earlier. So probably I think we were averaging around $81 or $82 per barrel, if I'm not mistaken. And then we've had this rise. So again, if you kind of, for the rest of the year, if you take that the price averages around $90 to a barrel, I think still we'll probably end up something in the 85, 87 kind of a range. So that's not too different. So in that sense, I don't think RBI needs to make any big change to its oil price assumption. And therefore, for the same reason, on an average for the year, I don't think this is going to affect economic variables too much. But of course, on a sequential basis, second half, you can say that maybe higher oil price will be a bit of a headwind to second half growth. It probably kind of pushes up inflation expectations in second half. So maybe there is a difference between first half and second half. But for the year as a whole, I don't think it changes the calculations much.
All right. So, even moving aside from the RBI, so in general, when it comes to oil prices, what's the expectation? So far, simply because pump prices are unlikely to change because of a whole host of reasons, or at least that's the expectation. The expectation is that inflation is unlikely to see a hit from rising oil prices. However, external indicators might see a little bit, though not so much of a dent. Could you elaborate a little bit on that?
Yeah, so I think before this recent rise in crude prices, I think the general expectation, obviously market expectation as well as among probably among the general public was that at some point the fuel prices will get cut, right? So you had the LPG price cut. I think the broader, whatever public expectation would have been like in the festival season, maybe closer to Diwali, there could be a petrol diesel price cut also, because we have been hearing reports that oil companies have kind of recouped some of or a lot of their losses, and probably they started to make money at least on petrol. I'm not sure about diesel. In that context, I think there was an expectation that prices might get cut. So obviously, this rise kind of puts a spanner in the works. So maybe it is not so easy for oil companies on their own to cut prices. Maybe government will have to step in. They can adjust the excise duty, or maybe they can give an explicit subsidy, whatever. But I still think directionally, I think we are still looking at some token price cut because the prices have been held constant for so long. So basically what I'm trying to say is we don't expect a price hike because of this kind of rise in crude prices. I think even if this persists, the government will try to adjust excise duty so as to give relief to both the oil companies and consumers. So we don't expect a price hike in India anytime soon with these kind of global crude prices. So in that sense, it doesn't affect inflation directly. On the external accounts, yeah, you are right. But like I mentioned again, for the full year, average is not changing much. So therefore, I don't think there's too much of changes to those numbers also.
Got it. All right. And moving on to inflation, we're again seeing headwinds from erratic monsoons. September did see a significant catch up in rainfalls. However, pulses sowing remains a little bit of a concern. What's your reading on the inflation front?
So I think a lot of the rise and volatility in food inflation and therefore headline inflation came from vegetable prices, which have already started correcting. I think they corrected in last month's reading itself. Further correction has happened in September. And of course, once we enter into winter, we know that vegetable prices have a history of coming down quite sharply. So I think that should happen. Obviously, like I mentioned earlier, I think the pressure points are cereals and pulses. And now pulses sowing is actually lower than last year. I think it's not just a question of monsoon. I think we are coming out of a period of low pulses prices. And of course, government has been very proactive in allowing pulses imports. So because of these reasons, I think anyway farmers have been a bit reluctant to increase the pulses acreage. So that is a different problem. Again, we have to see how the government manages it through imports. Now, cereals, we'll have to wait and see. I think we had a bad June, and then July was better in terms of rainfall, and therefore the sowing activity was good. And then again, I think there was a hit in August, and then rains have increased in September. So purely from a sowing point of view, it looks okay. But we'll have to wait for the harvest and see. So if the harvest for some reason is a bit weaker because productivity or the yield is on the lower side because of this erratic rainfall, like you mentioned, then obviously that has implication. Once the harvest comes, that's when the government builds up its stocks, and then those stocks can be used later to kind of cool down prices in the open market. So if the harvest is a bit weak, then the stocks don't get built, and I think then the open market prices can keep rising. So I think a lot depends on the strength of the Kharif harvest. So for that, we have to wait and see.
All right. And the RBI, too, in its previous statements, hinted that given the scenario, policy supply side interventions might be of more help in the current situation. What would you say?
No, so on food, obviously I don't think there is any other option, right? I think supply side interventions have to be the first choice. And it's not like those attempts haven't been made. I think the government, for example, obviously on the trade side, they have banned the exports of rice. I think different varieties of rice, one after other, they have banned them. And I think there have been some open market sales also. But despite that, prices haven't cooled as much as one would have anticipated. Which just tells that underlying, I think there is an issue in terms of the rice stock available in the system. So like I said, again, it's after the harvest, the stocks will get replenished. So we'll have to wait and see. So I think it's difficult to kind of take that call before we know what kind of arrivals come in the market once the harvest season starts.
All right. On liquidity conditions, what's the expectation? Can we expect the RBI to once again reaffirm that there will be adequate liquidity in the market?
Yeah, I think from as far as the language goes, that's what they will say, but we'll have to see what their actions are. I mean, last time they imposed something called ICRR, incremental CRR, and we thought that they will kind of continue with that, maybe at a lower rate through October and through maybe first half of November also, but somehow they've kind of reversed it completely. So I think it's a bit confusing in terms of liquidity, what exactly RBI wants. I think the natural whatever drivers of liquidity are such that over the next couple of months, liquidity should start draining from the system. But whether the RBI is kind of willing to be patient and allow that natural process to happen, or do they want to speed up the draining of liquidity, I think that is something it's not very clear. Probably the policy will tell us. My own view is they shouldn't do anything. They should just let the currency leakage during the festive season. That should take away a lot of liquidity. And on the forex side, also, we don't expect any big surplus flows coming in. More or less, on the BOP side, it's going to be balanced. So it's not like liquidity activation will take place through the route. So your currency leakage will basically take out a lot of the surplus liquidity which is in the system currently. I think the RBI should just allow it to kind of play out. But the risk is that they want to kind of speed up the process. They want to suck out liquidity a bit faster. In that case, then they might have to do something. But again, like I said, they reverse the ICRR, which shows that maybe they are not in favor of CRR. So once you take CRR out of the equation, I don't think they have too many tools to suck out liquidity also. So this is a bit of an unknown in terms of what RBI is thinking. We'll get to know in the policy.
Sure. So, before I let you go, I do want to understand what your reading is of the economic scenario. We have touched upon some of the headwinds by way of higher oil prices and erratic monsoons. But in all, domestic activity remains resilient and will prove to be a source of comfort for the central bank.
Yeah, that's right. So I think when you look at high frequency data, I think the data or the activity levels have been quite strong in August and probably early indicators for September also. I think sequentially we shouldn't forget that since this is the festive season, I think a lot of companies will be doing inventory restocking. That itself kind of gives a boost to manufacturing and whatever the output data. Obviously there are pockets of strength like passenger vehicle sales, for example. I think even petrol, diesel consumption. So obviously I think RBI is at 6.5% growth for the year. We are at 6%. I think the consensus probably is closer to our number. So maybe I think there is a difference of opinion on how strong this growth is. But by and large, yes, you are right. I think economic activity has been resilient. The headwinds are more coming from the external side because of export slowdown. And like we discussed, I think oil prices going up. But domestic activity by and large has been quite resilient.
All right. Thank you so much for taking time out for us today. This was most invaluable.